Even high morning. What is your sense? Will the RBI please the markets today?
Yes, good morning. Well, I think general expectation is that market would probably, or the RBI would probably have 25 basis point cut into the repo rate, and also the expectation is that they would probably also have the CRR cut along with. Both these things put together would have, I think, definitely positive impact on the rate reduction cycle going forward. Of course, I think the calculation wise it suggests that I think if you bring down the CRR by 25 basis point, then overall impact I think on the profits of the banks I think could be somewhere around 2%. I think that is what one could calculate in general. And at the same time, I think if one is bringing down the rate of interest, I think again the lending portfolio might have slightly negative impact, but on the other side the treasury portfolio of the banks could end up with a positive impact, and the positive impact could range between 2% to 5.5% depending on the size of AFS portfolio which every bank carries. A bank like State Bank of India would have about 2% kind of a positive impact coming onto the bottom line, and around 5.5% kind of impact could be seen in the banks like I think Oriental Bank of Commerce, or even for that matter Punjab National Bank, which has 25% kind of AFS portfolio, could see I think around 5%, 4 to 5% kind of impact onto the bottom line. So overall I think it's going to be more positive for the banking sector, and more importantly the RBI's policy, which when it spells out the kind of a direction forward for the rate reduction, it would be all the more positive. So yes, I think this credit policy of RBI certainly should please the market. That's what I would also conclude.
What are your thoughts on HCL Technologies? For this year, HCL Technologies has already appreciated by about 27% plus, and this is after a 60% appreciation in 2012. Now, if I map the FY14, not FY13, it's almost FY14. FY14 P multiple for HCL Technologies, it is trading at 18 times, about 19 times. Does HCL Technologies deserve to trade at a P multiple of 18-19 times?
Yeah, Nikunj, I think you're so right. I think the valuations have scaled up, and as I see it, I think the way in which the investors or the traders have looked at, I think this kind of valuation is largely to basically find out the alternatives into the markets. Already TCS and Infosys are at a level at which I think the higher level of upside is I think denied in the marketplace. So from that perspective, I think HCL Tech was becoming a natural choice, and the company, having changed its business model, was suggesting an up move. In fact, I think the company was quoting at 11-12 kind of price earning ratio for a long period of time in last year, and it has moved up very significantly. To my mind, I think the stock has become expensive at this point of time. The further headroom probably I think is less as I see it, and certainly I think it calls for some amount of profit booking as far as investors are concerned. For the traders, I think they have parked their money in a safe haven in IT. So obviously I think you would like to ride it as much as possible till the time I think you see the conducive environment happening on the other side of the market, which is the growth side of the market. But for investors, yes, I think some amount of money can be taken off the table and I think book profits here.
Even the mere suspicion that private banks have gone wrong in implementing KYC norms properly has got private banking stocks down. Do you think this is a good time to put money to work in Axis Bank, HDFC and ICICI Bank?
Yes, I would like to put I think investment money back into these stocks, but maybe I think some sort of correction is missing I think in particularly at HDFC Bank. HDFC Bank having corrected from 670 odd levels, I think it is still not enough. According to me, I think it is still valued at I think a good amount of valuation. But for ICICI Bank and Axis Bank, I think the valuation stays relatively on a lower side. If one wants to buy with the clarity, then certainly I think one would like to get the full clarity coming out of this particular episode. But to my mind, I think any fall into the market price of ICICI Bank or Axis Bank for that matter, I think would be a good buy opportunity, because the valuation stays quite comfortable under 1.5 times price to book value, which is probably factoring most of the I think the adverse factors which the companies would have. And I think that's where I think my comfort level would be to add more in falling market vis-a-vis I think selling it out at this point of time.
Even the tilt of the market towards defensives is getting more and more prominent, by the days. Do you think the outperformance in pharma and FMCG stocks is here to stay for a while?
I don't know whether we'll call it outperformance hereafter, because I think most of the pharma and FMCG stocks are quoting at a reach valuation. Particularly when compared with the market, I think they're certainly looking very rich. Even at the same time, I think if you look at the growth within those companies, I think the valuations are not at all cheap at this point of time. So certainly, I think whether to call them outperformers going forward, I think it would be quite a risky call, according to me. Would trade little cautious at this point of time. On the contrary, I think I would keep my eyes and ears open on the development side of the economy, the growth side of the economy. And should that happen, then some of the good quality banking stocks or some of the good quality infrastructure banking companies, or for that matter, I think asset ownership space within the infrastructure could become a natural choice to buy into the portfolio. And that could give far better return than the ones I think which are right now already quoting expensive. So maybe it may make sense to have some cash on table, keep it ready for deployment. I think as and when the environment becomes, I think, much more confident, then probably I think one could start deploying those money into the growth areas which I have spelled out just now.
The reason why Bajaj Auto was outperforming was because Bajaj Auto has a strong dependence or reliance on exports. The export story is still intact, but the stock has fallen 8%.
Yes, I think the export story is intact, Nikunj, but at the same time, let's not forget that Sri Lanka dominates a lot as far as I think the exports are concerned for Bajaj Auto. And certainly Sri Lankan government asking for higher amount of duty on import of vehicles, I think is going to affect Bajaj Auto to an extent. That's where I think the nervousness is, that on one side the domestic market is stagnating, is not growing at all. At the same time, in the export market, some of the pockets have started giving trouble. Earlier, I think they had increased the price, and for a few months, Bajaj Auto had difficulty in probably covering up its volumes. Again, I think if they increase the duty, then probably same situation could repeat. So that's where I think market is wanting to trade cautious. Of course, I think the companies on its strength, the product strength, is certainly looking, I think, much comfortably placed compared to many others in the marketplace as far as the peer segment is concerned. But for sure, I think one would like to buy at lower levels. And unfortunately, I think this market is traded mostly by the traders. So obviously the traders, when they see headwinds, they would start knocking down their portfolio at whatever price. And that's where one is not developing larger amount of comfort level. But certainly anything which is, I think, a discounted valuation, say for example 12-13 times on a forward price earning estimates, one could possibly, I think, start looking at this space and buy into the portfolio once again.
Devin, what are your thoughts on mid-cap cement stocks? If I look at the current PE multiple or the EV by EBITDA of large cap cement companies, compare that with mid-cap cement companies. Mid-cap cement companies are trading at a 50% discount.
Yes, you are right, and I think most of these mid-cap companies, I think, are also regional players. So obviously, I think it would depend on pocket to pocket as to where exactly they are employed the strategy. Take a case of Madras Cement, I think two distinct advantage for them. The southern market for cement probably is, I think, showing a growth traction, and that's where I think the company is basically wanting to sell more amount of its capacity out there in the southern market. That's one point, I think, which is going in favor of this company. At the same time, captive power is basically helping them in bringing down their cost as far as I think the inputs are concerned. And that is once again, I think, a positive thing for a company. Certainly, I think the gap between the large cap and the mid caps, I think, which was due to the national presence and the regional presence, I think has started narrowing down because of the want of higher amount of growth in this particular space for the investors in their portfolio. That's where you are seeing this particular bridge in the gap. I would think that companies like Madras Cement and Shree Cement certainly, I think, remains, I think, favorable picks within the mid cap space and could possibly stay, I think, above some of the large caps ones. Whether Madras Cement has already run up to a great extent, but I think whether it would have 20-30% rise, I am slightly careful about that part. But certainly, I think to hold that stock in the portfolio and ride the boom, I think, which is happening into the sector, one could get the best out of it.
Devin, what are your thoughts on commodities? Now, the street is clearly divided on commodities as a group. Bulls are of the view that commodity stocks are attractive and they qualify as value bets for long-term investors. The bears are of the view that don't go close to commodity stocks because the data from China is confusing and the super cycle in commodities now is behind us and commodity stocks will do nothing for next 3 or 4 years.
Well, on the fundamental front, yes, you find, I think, many of the companies, including Tata Steel, available at a single-digit P, of course, I think, but I think much lower single-digit P, as I would call it. So from that point of view, I think on the strength of the balance sheet or the strength of the, I think, price in the market, the stock is not looking bad at all. I think it's attractive. However, I think the larger amount of play in the commodity segment is by the traders, and that's where I think one is not very comfortable about. The global economic signals are not, I think, coming very positive. The local economy, I think the demand scenario is remaining positive despite of whatever the slowdown that we are talking about. The pricing scenario is remaining uncertain, so that is putting us off as far as, I think, the buying aggressively into the commodity space. But yes, I think any fall into the commodity space would demand a relook and probably, I think, buy into the portfolio. Maybe I think the safer of the lot could be Hindalco within the space to play with, and I think any fall into that stock price could possibly demand an accumulation and a buy into the portfolio. I'm not too sure in immediate term, I think, how much appreciation one could get, but a shorter term duration also, I think Hindalco kind of a company has the potential to give 15-20% kind of an appreciation.
It's been good having you on the show. Appreciate you taking the time out and joining in.